there. Welcome back once again to the Money Show. Today joining us on the show is Mr. Hemant Rustagi of Wiseinvest. We're going to be talking to him about everything that's been happening in the markets and how to keep your portfolio safe and sheltered from everything that's been happening. But before that, here's a little reminder for you as you watch the Money Show every day. Keep writing to us and keep sending us all your queries. The number is on the screen. Send us your queries on 865-797-4571 regularly and get all your mutual fund related queries answered by experts. But let's once again welcome Hemant Rustagi on board. And Hemant, thank you so much for joining us. And it's a big concern that our viewers and everybody in the market who have investments in the market have right now. The markets have been weak and volatile. It's been the sixth continuous session, in fact, where the Nifty has tanked. First up, before we talk about how to shelter your portfolio, first up, what's your message to investors who are currently struck with panic and are trying to make sure and trying to ensure to keep their investments safe? What's your wise word to them as of now?
Well, Sahi, I would say that these are really can be very testing time for investors, especially those who started investing maybe in the last year or so, because it's the first time they are seeing extreme volatility in the market and the way the markets have gone down over all the three segments, in fact more so in mid and small. So obviously these can be testing time, but it's an important factor for every investor to remember that the volatility in the stock market is a natural phenomenon. And it keeps happening from time to time and of varying degree depending on, and also based on different reasons. Sometimes it can be pure economic reasons, sometimes it can be political reasons, sometimes it can be geopolitical, sometimes it can be a combination of all these. So what we are seeing is, like I said, it can be a testing time for investors. But there are two kinds of investors. One, there are investors who plan their investment well. Good thing is that where we've seen Indian investors have been investing through SIP. Most of them are now trying to align these investments to their goals, which means that if they're investing in equity, they're aligning this investment to their long-term goals like children education, maybe retirement. So what happens is when you have aligned your investment to your goals, you have a clarity that okay, I have another 10 years to go, 15 years to go, or 20 years to go. So every time the market turns volatile, they don't have to really worry too much about it because they know how much time they have on hand. And the second thing is, you're also investing systematically. The reason why you invest systematically is because you do not want to commit investment at one particular level. Because you are disciplined, because you're committed to invest on a certain date of the month, you in fact benefit from this kind of volatile market. So I don't think any investor who has been investing through a plan, have their goal defined and also their time horizon is very clearly defined, they need to worry. If you are someone who started investing randomly, maybe looking at, okay, the markets are doing well, let me take advantage of that, let me keep increasing my SIP, even if whether I can afford it or not. If you are one of those kind of investors, my recommendation would be that this is the time to take stock of your investment. If you didn't do in the beginning where you kind of defined your goals, time horizon, do it now. And if you find that you made your portfolio very aggressive, this is the time to set it right. Surely. Within equity also I would say that it can happen that when the mid cap and the small caps are doing very well, and if any investor has made his portfolio very aggressive by investing predominantly in these two segments, this is the time to maybe kind of have a relook. But my view is that if you're a long-term disciplined investor, don't worry, there is no need to panic. Continue your process uninterruptedly, and trust me, the investment that you make during these times are going to help you actually improve your return over a longer period. But if you're not a disciplined investor, you didn't plan it, this is the time to maybe kind of sit down and have a look at your portfolio and see whether it's really suitable to your time horizon.
Well taken. Thanks for those wise words, Hemant. But during a correction like this, should investors focus more on short-term risk mitigation or long-term growth opportunities? And how do different products, the likes of equities or mutual funds or fixed deposits, how would that fit into this approach?
Well, here again, like I said, if you have planned your investment well, so what happens? All of us have short-term goal, medium-term goal, long-term goals, right? So usually what you do is, if you have short-term goals, you know that the capital safety is more important than the return. So you kind of put your money in the debt or debt-oriented instruments. If it is a hybrid, if it is medium term, then you're looking at hybrid, a mix of equity and debt. If it is long term, maybe you are going into predominantly equity. That's how you do your asset allocation. So my view is that since this correction is there and we don't know, it may continue for some time, or if you may see some kind of time correction in the market. In a time like this is not the time to really define things for yourself. So if, like I said, if you have done allocation in line with your time horizon, you don't have to do anything. You can just continue with your process. Of course, if you have some money to be put aside, again, look at what is the time horizon. If you need money for the next 1 year or so, obviously you can't get into equity, even if the market may look very attractive to you, because we don't know where this correction is going to stop. But if it is available for long term, surely you can allocate, in a systematic manner. I'm saying in a systematic manner. I'm not saying that you go ahead and put all your money tomorrow. You can allocate it to your long-term goals, but do it systematically through a systematic master plan. So it all depends on, again, like I said, you must have a clarity in terms of this money which is available to you. What is your time horizon? What is that you're trying to achieve with that? If you stick to that, I think you will not go wrong with that.
But Hemant, at a time like this, how should you diversify your portfolio across asset classes, the likes of equities, mutual funds, fixed deposits, in a way that you reduce your risk during a market correction like this? And at a time like this, what would an ideal, well-protected portfolio look like for any investor?
Well, I think, like I said at the beginning, asset allocation is the key if you want to really handle a different kind of market scenario. So like I said, if you are someone who has not done it before, this is the time for you to really have a relook at your portfolio, try to kind of define your goals, time horizon, and see whether you need to make any changes in the portfolio in terms of even within equity or across different asset classes. The most important part is that while you are doing it, you need to consider a couple of things. You need to look at, for example, if you look at mutual funds, the best thing about mutual fund is they allow you to invest for a day, for a year, for a decade. So I think there are investment options across. Then you need to also look at what kind of flexibility which is there. You also need to look at, what is the tax efficiency of return. Look at these factors and build your portfolio. Look, every asset has a role to play in your portfolio. But it all depends on your risk profile, and the risk profile generally would emanate from the fact that how much time you have on hand and what is your investment goal. So as long as you keep focused on that, I think irrespective of any market condition, your portfolio will be fine. And like I said earlier, if you're investing through SIP, this is the time where you are actually getting to invest at a lower level, which will bring your average cost down. So if you have to allocate fresh money, the rules of the game are the same. Okay, whether the markets are doing very well or whether the markets are volatile, it all depends on what your needs are. If you design your portfolio in line with the market mood, trust me, what will happen is, in a market which is doing well, you will make your portfolio very aggressive. In a market where you're seeing correction or volatility, you will make your portfolio very conservative, which will harm your financial future. So I think you always focus on what your requirements are, what your risk profile is, and I think that works well for every investor.
Let's just focus from equities and other products to a commodity now that usually is a feature of a common portfolio, and what I'm talking about is gold. Do you think now would be a good time to shift some allocation from securities and put that money into gold, since gold is usually known to be a hedge against inflation, but also factor in all the geopolitical developments that we're seeing in the world? Do you think that's going to provide a good fillip to gold as well?
Well, I agree with you. I think gold always has a role to play in your portfolio. The key factor is, how much exposure you should have in gold, at what stage you should have. It's not that because gold is an option that you go ahead and invest in gold. Yes, it has all the characteristics that you mentioned about. We're talking about a tactical asset allocation here. Now that can be a bit tricky. Now, for example, if I have a long-term money, which I don't require for the next 10 years, and I'm afraid about what is happening in the stock market. So I'm looking for some kind of protection. I go and invest my money in gold. Suddenly if there is a turnaround, who knows? It can happen after a week, it can happen after 2 weeks. then it is very difficult for me to take out money from there and allocate. So what happens in the long run? The money that ideally should have gone into long-term asset like equity has gone into an asset class which is at best acting as a hedge. So I think it's very, very important to be very careful when you're doing tactical asset allocation. Be very clear of what role you expect the money which you're investing now to play in your portfolio. Like I said, if you're looking for short-term parking of funds, or maybe looking at a year or two, maybe yes, you can definitely look at gold as an option there. But if it is essentially a long-term money, I wouldn't recommend it.
That's the view coming in on what role gold can play in your portfolio. But Hemant, let's talk about someone or in fact a group of investors who are cautious in nature generally. Do you think now is a good time for these select group of investors to book out some profits even though the market is tanking away since the last week and even today? Do you think now is a good time to just exit a few investments that have not done well for them, sit on cash and hold on to that cash in case the market corrects further and buy on dips going ahead?
Well, essentially we are talking about timing the market again, right? So the point is, like I said, it's very, very difficult. Even the best of the fund managers find it very difficult to do it correctly all the time. So I don't think that's a great idea. See, for example, as I mentioned earlier, if you are very clear about your time horizon, if you don't require that money for many years, if you book the profit, you don't know when the market will see a turnaround. It can be, you can't time it perfectly both ways, okay? So for example, if you exit now, the market goes down, you'll be happy about the fact that, okay, you exited at the time when the markets have gone further down, but when suddenly there is a U-turn, you'll keep on waiting, maybe expecting the market to go down further, and you miss an opportunity to bring the asset allocation back to where it should be. So that, I think the timing is very, very difficult, but of course, it is always recommended that even if you are following a goal-based investment process, once you are nearing a completion of your goal, the time horizon, for example, if I'm investing for the last 10 years and my goal is maybe 1 year away, it's always advisable, irrespective of what happens in the market, to kind of start rebalancing your portfolio in a phased manner, which means that you start moving into safer asset classes so that you can protect all the gains that you've made over the last 9-10 years. So that obviously would be a sensible thing to do if someone requires money over the next 6 to 12 months. As you rightly mentioned, the markets have already seen the fall, but we don't know how much further it is going to go down or when it's going to turn around. Do it in a phased manner. It's not that tomorrow you have to go and redeem all your investment. You can do it in a phased manner, because if you have 1 year time, there is always an opportunity for you to see the market turning around or bouncing back, and obviously protecting the earlier gains that you made. So yes, if you require money in the short term, maybe it's the time to kind of in a phased manner start exiting. But if you don't, if you are sticking to your asset allocation, I don't think you need to do anything. Continue with your investment process. Trust me, this is the most important thing. Many times we are guilty of making some decision in haste, and that usually go against us. I think just stick to your asset allocation, continue your process, you will do all right.
Okay, so some word of advice coming in from Hemant Rustagi for everybody who is worried and looking for an answer, looking for a light at the end of the tunnel. We don't know when it's going to come, but the word is keep going on the path that you've set yourself for the long term. But Hemant, also help us understand what role do products like bonds or government-backed securities play in providing stability during a market correction like this, and should they also be prioritized in one's portfolio?
Well, I think as I mentioned earlier, like if you've defined your goal and you are someone who require money, let's say in the next 1 year, 2 years, and you know that the safety of capital is the priority for you, then obviously there are different options. There can be very short-term debt funds, there can be bonds, there can be liquid funds. There are different options that are available. You get into these products looking at what kind of return you're expecting, what is your time horizon, what kind of flexibility you want. Sometimes what happens, you feel that I have a couple of years to go, so maybe I can, put this money aside in an instrument which is safe and I get slightly higher return, but the liquidity is not there. But that can prove costly in case you require the money prior to that 2-year time horizon that you thought you have. So I think when you select any instrument in any asset class, look at these factors, look at liquidity, look at flexibility, look at tax efficiency of return, even for a short term. I think it's important to look at these aspects and then make a decision. Of course, there are different options available to you which are suitable for different investors, there are different risk profiles. What you need to pick and choose is what works best for you.
Choose what works best for you is the word coming in from Hemant. Hemant, lastly, if you could just answer some quick rapid fire style questions that I have for you, just on the base of a pecking order of the preference that you would have amid a market correction like this. Let's kick start. And equity versus a fixed deposit, what would be your pick right now?
Sorry, can you just repeat that? I missed.
Sure. So very quickly, in just a one-word answer style, if you could just tell me if you had to choose between continuing with equities or putting your money into fixed deposits, what's your call right now?
Well, I stick to my asset allocation. If I've done it well, if I've done it properly, I would not make any change at this stage, irrespective of the market conditions.
Okay, equity versus gold?
Well, again, like I said, if it is long term, I would go for equity. If it is, I'm looking for some tactical asset allocation for maybe short duration, maybe for a year or for a year and a half, maybe I'll look at gold.
Okay, well, so these are the key takeaways from this very fruitful discussion that we've had with Hemant about what to do when it comes to sheltering your portfolio or defending your portfolio from the market moves and the volatility that we're seeing. But Hemant, let's switch focus. Let's talk about some queries that we'll be throwing your way now that our viewers have sent us in terms of their individual portfolios and how they can alter it, increase or decrease exposure to certain funds based on your valuable word of advice. So let's just get kick-started with the first query coming in. It's an email query and it's coming in from our viewer Jishnu, and he says, could you help me build a portfolio? He has 9 lakh rupees invested in mutual funds and he currently has Quant ELSS, Parak Parik ELSS, HDFC Retirement Fund as well as ICICI Retirement Fund with 2 lakh each, an SBI Liquid Fund and as an emergency fund with 1 lakh rupees in it. His question is, should he continue investing 30,000 rupees SIP monthly into the funds that he has mentioned? Should he introduce another mid or small cap fund? He has a 15 years investment horizon and plans to do a 10% step up. So what's your advice here?
So I think the key factor there is this time horizon, which is 15 years. So obviously it's a long enough time, and the best thing is that since it's investing through SIP, which is a disciplined way, so I think for a long term, as I mentioned earlier, I think equity is a good asset class to invest in, but of course you need to look at certain factors. What I see in the portfolio, I see a couple of ELSS funds, so maybe you require just one ELSS fund. You can look at Quant ELSS fund. There are 2 retirement funds, which I guess is one obviously to build retirement portfolio as the name suggests, and also maybe it is looking at some tax rebate. So investment into these 4 funds would clearly depend on how much he needs to invest to save taxes. I'm hoping that he's investing only that much money which is required to be invested to save taxes, because many times investors make the mistake of investing more than what is required in these options, thinking that there is a lock-in period and you will get a better return, which obviously is a myth. So one is something that he needs to look at. Second, he mentioned about who's investing around 6,000, I think, in a liquid fund. Now, building an emergency fund through liquid fund is a great idea. It has to be an investment option where the money is available at any point in time, but the quantum is equally important. Okay, if he still thinks that he needs to build up it further, he can continue in that and think of long-term investing later on. But if he has built large enough, corpus for retirement fund, then he can move this money to some good quality equity fund because he has a time horizon of 15 years. Maybe he can look at a large and mid-cap fund, which means that your money is invested in the top 250 companies in the market in terms of market cap. So maybe that's one option that you can look at.
Okay, well, let's bring in the next query on board, and that's coming from Mr. Vinod Kumar from Himachal Pradesh. And in fact, we have him joined with us on the show via a phone line. Mr. Vinod, thank you so much for joining us on the show, and thanks for writing your query to us as well. And his query is that his brother is a serving defense officer with 7 years to his retirement. He's 53 as of now, and he has accumulated a very large number of mutual funds. The schemes will be flashed on air as well. Now, his purpose is to create a corpus of about 50 lakh at the end of 7 to 8 years. So next up, we'll also be bringing in the voice of Mr. Vinod Kumar, and he can ask you the query directly, and please help him out.
Hello?
Yes, Mr. Kumar, please go ahead.
Yeah, this is very, very large and too much diversification. So I had wanted some advice regarding how we should cut down on what all funds, because even I was not able to advise him. Basically, aim is to accumulate wealth by the time he retires in 7 years or 8 years.
Okay, Mr. Hemant, let's give it a go.
So
What's your answer to that?
So what all funds, like he has got 2 blue chip funds which is not required. It can be condensed into one. And which all funds he should just remove and concentrate his effort on few funds, maybe 5 or 6 of them.
Okay, Mr. Kumar, we've got your query loud and clear. Let's just get in the expert view here, and Hemant, go for it.
Yeah, I think one thing is very clear, which is also recognized, the fact that there are too many funds in the portfolio. There are 15 funds in the portfolio. So clearly there is a need to consolidate to reduce the number of funds, because when you have too many funds, it doesn't really work in your favor, because they behave exactly the same, as there is overlap. And you will always find that some of the non-performing funds you remain invested in them, and they bring your portfolio return down. So yes, there is a need to consolidate. If you bring it down to 6 or 7, it's also important to see whether he is investing through SIP or investing lump sum. Certainly, if it is still there, Mr. Vinod, I would like to know whether this money is being invested through SIP or is investing on and off or a lump sum. Okay, it is not there with us. Sorry.
Yeah, that has not been done, but total accumulation is about 4 lakh divided into 15 funds, which is, I think, not a good sign. So I recommended him that you should start SIP in just 5 to 6 and concentrate all the effort into that.
Oh yes, absolutely. Since he has another 7 or 8 years to go for retirement, I think it will be ideal way is to invest through SIP and also reduce the number of funds consolidated. So I would recommend some funds, you can consider. If you are investing in ELSS, quant ELSS, you can continue with that, because that's obviously maybe the tax saving. SBI retirement fund you can continue. Then I see SBI contra fund. So 2 funds from SBI mutual fund, I think you can continue. And then there is Kotak Multicap, which is I think one of the best multi-cap funds at the moment. This fund allows you to invest in all 3 segments. That can be retained. And then there is a large cap fund, ICICI Blue Chip Fund, which again I think has a very long-term established track record, can be looked at. And one more fund I would like to add, maybe Motilal was for large and mid. So 6 funds as against 15. This will ensure that your brother has exposure to all the 3 market segments and in the right proportion. And of course, as you rightly mentioned, he should be investing through SIP. I think that will not only reduce the impact of volatility on the portfolio, but also help him build larger purposeful power of compounding.
Thank you so much for your query. Please keep writing to us like this. But Hemant, we have time for just one small query. I'm going to try to squeeze in on the show. And this query is coming in from Mr. Manohar from Hyderabad. He is investing in the SIB Blue Chip Fund via SBI Blue Chip Fund, via the SIP route for the last 6 months, roughly 5,000 rupees per month. Now he's planning to switch to the SBI Large and Mid Cap Fund. Do you think this is going to be a good move?
Well, ideally I would like to know what is the overall composition of the portfolio, how much allocation is there in different segments. But since we do not have that information, we're looking at purely moving money out of, a pure large cap fund into a large and mid cap fund. I think that can be a good strategy too in the long run. So if you have time horizon for 10 years or maybe even more. But I think that in this category there are other funds. I did mention about Motilal also a larger mid cap. There is also HDFC larger mid cap, which I think can be better option than the one that is considered.
Well, so that's the answer coming into Mr. Manohar's query. But on that note, I'm afraid we're completely timed out on the Money Show, this edition of the show. Hemant, thank you so much for joining us. Viewers, thank you so much for writing to us. Please keep writing to us. We'll be flashing the number on the screen shortly. Well, on that note, it's a goodbye from me and the team that put this show together. Thank you so much for watching.